Question 1. When evaluating the potential risks associated with a new product launch for KE Holdings, which of the following approaches to risk assessment is most aligned with regulatory expectations for comprehensive risk identification and mitigation? Option A. Basing the risk assessment on informal discussions and the consensus of a small group of senior managers without formal data collection or analysis. Option B. Relying primarily on historical performance data of similar past products, assuming that future outcomes will closely mirror past trends. Option C. Focusing exclusively on risks that can be easily quantified through financial modeling, while disregarding non-financial risks such as reputational impact or operational disruptions. Option D. Conducting a thorough review of all available internal and external data, considering both quantitative metrics and qualitative factors, and assessing the interdependencies between different risk categories, while also seeking independent validation for key assumptions. The correct answer is D. Conducting a thorough review of all available internal and external data, considering both quantitative metrics and qualitative factors, and assessing the interdependencies between different risk categories, while also seeking independent validation for key assumptions. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a nuanced understanding of risk assessment methodologies within the specific regulatory framework of KE Holdings. The challenge lies in identifying the most appropriate approach when faced with incomplete or potentially misleading information, necessitating a judgment call that balances thoroughness with efficiency. Professionals must demonstrate an ability to discern the limitations of different risk assessment techniques and select one that aligns with regulatory expectations for identifying and mitigating potential financial and operational risks. Correct approach analysis. The correct approach represents best professional practice because it prioritizes a comprehensive and systematic review of all available data, including both quantitative and qualitative factors. This aligns with regulatory expectations for robust risk management, which mandates that firms understand their risk exposures thoroughly. By considering the interdependencies between different risk categories and seeking external validation where necessary, this approach ensures that the risk assessment is not only accurate but also forward-looking, allowing for proactive mitigation strategies. This aligns with the principles of prudent risk management and adherence to the spirit of regulatory oversight, which aims to prevent systemic failures and protect stakeholders. Incorrect approach is analysis. One incorrect approach fails by relying solely on historical data without considering emerging trends or potential future disruptions. This is a regulatory failure because it neglects the dynamic nature of financial markets and business operations, potentially leading to an underestimation of future risks. Ethically, it demonstrates a lack of diligence and foresight. Another incorrect approach is to focus exclusively on quantifiable risks while ignoring qualitative factors such as reputational damage or regulatory changes. This is a regulatory failure as many frameworks require consideration of all material risks, not just those easily measured. It is ethically problematic as it prioritizes easily managed risks over potentially more damaging, albeit harder to quantify, ones. A third incorrect approach involves over-reliance on anecdotal evidence or the opinions of a few individuals without rigorous validation. This is a regulatory failure because it introduces subjectivity and bias into the risk assessment process, undermining its reliability. It is ethically questionable as it can lead to decisions based on incomplete or biased information, potentially harming the firm and its stakeholders. Professional reasoning. Professionals should approach risk assessment by first understanding the specific regulatory requirements and the firm's risk appetite. They should then gather all relevant data, both quantitative and qualitative, and critically evaluate its completeness and accuracy. The chosen methodology should be appropriate for the identified risks and the firm's operational context. A continuous review and update process is crucial, incorporating new information and adapting to changing circumstances. When in doubt, seeking expert advice or performing further due diligence is a hallmark of professional responsibility. Question 2. The monitoring system demonstrates a significant increase in the number of alerts generated over the past quarter, with many alerts appearing to be repetitive or related to minor procedural deviations. Which of the following is the most appropriate next step in assessing the effectiveness of the risk assessment process? Option A. Immediately recalibrate the monitoring system to reduce the number of alerts, assuming the increase is due to system oversensitivity. Option B, disregard the increase in alerts, attributing it to normal fluctuations in system performance and focusing on other strategic initiatives. Option C, initiate an immediate firm-wide audit to investigate potential widespread compliance failures, given the surge in alerts. Option D, conduct a detailed review of a sample of the generated alerts to identify patterns, assess their root causes, and determine if they indicate genuine compliance risks or system inefficiencies. The correct answer is D. Conduct a detailed review of a sample of the generated alerts to identify patterns, assess their root causes, and determine if they indicate genuine compliance risks or system inefficiencies. Explanation: this scenario presents a professional challenge because it requires the assessment of a risk monitoring system's effectiveness in identifying potential compliance breaches. The challenge lies in discerning whether the system's output accurately reflects the underlying risks or if it is merely generating noise, potentially leading to misallocation of resources or overlooking critical issues. Careful judgment is required to distinguish between genuine risk indicators and false positives or negatives. The correct approach represents best professional practice because it involves a systematic and evidence-based evaluation of the monitoring system's performance against established risk parameters and regulatory expectations. This approach ensures that the system is not only operational, but also effective in its intended purpose of safeguarding the firm's compliance. It aligns with the principles of robust risk management and internal control frameworks, which are mandated by regulatory bodies to ensure market integrity and client protection. Specifically, it reflects a commitment to proactive risk identification and mitigation, a cornerstone of regulatory compliance. An incorrect approach that relies solely on the volume of alerts without contextual analysis is professionally unacceptable. This failure stems from a lack of critical assessment, potentially leading to a false sense of security or unnecessary alarm. It ignores the qualitative aspects of risk and compliance, focusing on quantity over quality. This can result in regulatory breaches if genuine risks are masked by a high volume of irrelevant alerts, or if resources are diverted from significant issues to investigate trivial ones. Another incorrect approach, which dismisses alerts based on a subjective feeling of too many, demonstrates a failure to adhere to established risk assessment methodologies and a disregard for potential regulatory scrutiny. This subjective approach lacks objectivity and is not defensible under regulatory review. It also fails to consider the potential for systemic issues that might manifest as numerous, seemingly minor, alerts. Professionals should employ a decision-making framework that begins with understanding the firm's risk appetite and regulatory obligations. This framework involves defining clear criteria for what constitutes a significant risk alert, establishing a process for investigating alerts that includes root cause analysis, and regularly reviewing the effectiveness of the monitoring system itself. This iterative process ensures that the system remains fit for purpose and that resources are allocated efficiently and effectively to manage compliance risks. Question 3. The evaluation methodology shows a systematic process for identifying, analyzing, and evaluating potential operational risks. Which of the following best describes the most appropriate approach for KE Holdings to adopt, considering regulatory expectations for robust risk management? Option A. A methodology that relies exclusively on expert judgment and anecdotal evidence to gauge the severity of potential operational failures. Option B. A methodology that prioritizes a comprehensive review of historical operational incidents and near misses, coupled with scenario analysis to anticipate future potential disruptions and their impact on business continuity. Option C. A methodology that employs highly complex statistical models requiring specialized software and extensive data manipulation, without clear integration into day-to-day operational decision-making. Option D. A methodology that focuses solely on the financial impact of risks, disregarding the likelihood of their occurrence. The correct answer is B. A methodology that prioritizes a comprehensive review of historical operational incidents and near misses, coupled with scenario analysis to anticipate future potential disruptions and their impact on business continuity. Explanation: scenario analysis. This scenario presents a professional challenge in risk assessment by requiring the identification of the most appropriate methodology for evaluating potential operational risks within KE Holdings. The challenge lies in selecting an approach that is both comprehensive and practical, aligning with regulatory expectations for robust risk management without being overly burdensome or theoretical. Professionals must exercise careful judgment to balance the need for thoroughness with the practicalities of implementation and the specific context of KE Holdings operations. Correct approach analysis. The correct approach represents best professional practice because it directly addresses the core principles of risk assessment as mandated by regulatory frameworks governing financial institutions. This methodology typically involves a systematic process of identifying, analyzing, and evaluating risks. It emphasizes understanding the likelihood and impact of potential events, which is crucial for effective risk mitigation and resource allocation. This aligns with regulatory expectations for a proactive and structured approach to risk management, ensuring that KE Holdings can identify and address potential threats to its operations and financial stability. Such a methodology fosters a culture of risk awareness and provides a framework for continuous improvement in risk management practices, which is a key ethical and regulatory imperative. Incorrect approach is analysis. One incorrect approach might focus solely on historical data without considering emerging risks or future uncertainties. This fails to meet regulatory requirements for forward-looking risk assessment and could leave KE Holdings vulnerable to novel threats not reflected in past performance. Ethically, it represents a failure to exercise due diligence in protecting the firm and its stakeholders. Another incorrect approach could be one that is overly qualitative and subjective, lacking clear metrics or defined thresholds for risk evaluation. While qualitative analysis has its place, a complete absence of quantitative elements can make it difficult to prioritize risks objectively or measure the effectiveness of mitigation strategies, contravening regulatory demands for demonstrable risk management processes. This approach also risks being perceived as arbitrary, potentially leading to inconsistent decision-making and a lack of accountability. A third incorrect approach might be one that is excessively complex and theoretical, requiring extensive resources and specialized expertise that are not readily available or practical for KE Holdings. While sophisticated models exist, the chosen methodology must be proportionate to the firm's size, complexity, and risk profile, as often stipulated by regulators. An impractical approach can lead to the risk assessment process being neglected or poorly executed due to resource constraints, thereby failing to achieve its intended purpose and potentially violating regulatory guidelines on effective risk management implementation. Professional reasoning. Professionals should approach risk assessment by first understanding the specific regulatory landscape applicable to KE Holdings. This involves identifying the key risk categories relevant to the firm's business model and operations. The next step is to select a methodology that allows for both the identification of potential risks and the assessment of their likelihood and impact. This often involves a hybrid approach, combining qualitative insights with quantitative analysis where appropriate and feasible. Professionals should then ensure the chosen methodology is embedded within the firm's operational processes, with clear responsibilities assigned for risk identification, assessment, and mitigation. Regular review and updates to the risk assessment process are also critical to adapt to changing internal and external environments, ensuring ongoing compliance and effective risk management. Question 4. Governance review demonstrates that a new financial product developed by the product innovation team is ready for market launch. However, the compliance department has not yet provided formal written approval, citing a backlog of reviews. The product development lead is pushing for an immediate launch to capitalize on a perceived market window, suggesting they can address any compliance queries after the product is live. What is the most appropriate course of action? Option A. Proceed with the launch, obtaining informal verbal confirmation from a junior compliance officer that the product appears to meet general requirements and address any formal issues later. Option B. Rely on the product development team's internal assessment of compliance, as they are experts in the product's functionality and intended market. Option C. Launch the product immediately to gain market advantage, and then initiate a retrospective compliance review to rectify any identified issues. Option D. Delay the product launch until the compliance department has completed its formal, documented review and provided written approval, ensuring all regulatory requirements are met. Correct answer is A. Proceed with the launch, obtaining informal verbal confirmation from a junior compliance officer that the product appears to meet general requirements, and address any formal issues later. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between the desire for rapid market entry and the imperative to adhere to robust governance and compliance frameworks. The pressure to expedite a product launch, especially in a competitive market, can lead to shortcuts that compromise regulatory adherence and ethical standards. The challenge lies in balancing business objectives with the non-negotiable requirements of the KE Holdings regulatory environment, which prioritizes investor protection and market integrity. Correct approach analysis. The correct approach, which involves a thorough and documented review of the product's compliance with all relevant KE Holdings regulations and internal policies before launch, represents best professional practice. This aligns with the fundamental principles of responsible financial conduct and regulatory stewardship. It ensures that the product meets all legal and ethical obligations, thereby safeguarding the firm from potential regulatory sanctions, reputational damage, and financial penalties. This proactive stance demonstrates a commitment to a strong compliance culture, a cornerstone of sustainable business operations within the KE Holdings framework. Incorrect approaches analysis. One incorrect approach involves proceeding with the launch based on an informal verbal assurance from the compliance department. This is professionally unacceptable because it bypasses the established, documented processes designed to ensure regulatory adherence. Verbal assurances lack the necessary audit trail and can be subject to misinterpretation or memory lapses, creating significant compliance risk. It fails to meet the evidentiary requirements for demonstrating due diligence and adherence to KE Holdings regulatory standards. Another incorrect approach is to launch the product and address any potential compliance issues post-launch. This is a critical regulatory and ethical failure. It demonstrates a disregard for the preventative nature of regulatory compliance and places the firm in a reactive, high-risk position. Post-launch remediation is often more costly, complex, and can result in severe penalties if discovered by regulators. It violates the principle of acting with integrity and in the best interests of clients and the market, as mandated by KE Holdings' regulatory framework. A third incorrect approach is to rely solely on the product development team's assessment of compliance, without independent verification from the compliance department. This creates a significant conflict of interest and undermines the independence of the compliance function. The product development team's primary objective is product creation and market success, which may inadvertently lead to overlooking or downplaying regulatory requirements. Independent oversight by a dedicated compliance function is essential to ensure objective assessment and adherence to KE Holdings' stringent regulatory mandates. Professional reasoning. Professionals facing such a situation should adopt a structured decision-making process. First, identify all applicable KE Holdings regulations and internal policies relevant to the product. Second, engage the compliance department formally to conduct a comprehensive review, ensuring all documentation and evidence are meticulously maintained. Third, if any gaps are identified, prioritize their remediation before proceeding with the launch. Fourth, maintain clear communication channels with all stakeholders, emphasizing the importance of regulatory adherence. This systematic approach ensures that business objectives are pursued responsibly and ethically, within the defined regulatory boundaries. Question 5. The performance metrics show a significant increase in candidate engagement following a recent adjustment to the assessment process, but also a slight uptick in reported concerns regarding the fairness of certain assessment components. Which of the following represents the most professionally responsible approach to evaluating these metrics? Option A. Focus on further amplifying the elements of the assessment process that led to the increase in candidate engagement, assuming the reported fairness concerns are isolated incidents and unlikely to pose a significant compliance risk. Option B. Rely on the positive trend in candidate engagement as an indicator that the assessment process is effective and compliant, and address fairness concerns only if they escalate to formal complaints. Option C. Immediately revert the assessment process to its previous state to eliminate any potential fairness issues, even though this might negatively impact candidate engagement and overall assessment effectiveness. Option D. Conduct a detailed review of the candidate engagement data and the reported fairness concerns, cross-referencing them with the specific requirements and guidelines of the KE Holdings hiring assessment test to identify any potential compliance gaps or areas for improvement. The correct answer is D. Conduct a detailed review of the candidate engagement data and the reported fairness concerns, cross-referencing them with the specific requirements and guidelines of the KE Holdings hiring assessment test to identify any potential compliance gaps or areas for improvement. Explanation. This scenario presents a professional challenge because it requires balancing the pursuit of business objectives with the imperative to adhere to regulatory requirements and ethical standards. The performance metrics, while indicating potential success, also highlight areas where compliance might be strained or overlooked. Careful judgment is required to ensure that the drive for results does not lead to actions that contravene the KE Holdings hiring assessment tests governing framework. The correct approach represents best professional practice because it prioritizes a thorough, data-driven review of the performance metrics in the context of the KE Holdings hiring assessment tests specific regulatory framework. This involves identifying any potential deviations from established compliance protocols, assessing the root causes of any observed underperformance or overperformance that might signal compliance issues, and then developing targeted compliance solutions. This proactive and analytical stance ensures that business decisions are informed by and aligned with regulatory obligations and ethical considerations, thereby mitigating risks and fostering sustainable growth. An incorrect approach that focuses solely on replicating the observed successful metrics without understanding the underlying compliance implications is professionally unacceptable. This could lead to the unintentional adoption of non-compliant practices, potentially resulting in regulatory sanctions, reputational damage, and a breach of ethical duties. Another incorrect approach that dismisses potential compliance concerns based on anecdotal evidence or a superficial understanding of the metrics fails to uphold the due diligence expected of professionals. This demonstrates a lack of commitment to regulatory adherence and a disregard for the potential consequences of non-compliance. A third incorrect approach that prioritizes immediate business gains over a comprehensive compliance review ignores the long-term risks associated with regulatory breaches. This short-sighted perspective can lead to significant future liabilities and undermine the integrity of the organization. The professional decision-making process for similar situations should involve a systematic evaluation of performance data against the relevant regulatory framework. This includes understanding the specific rules and guidelines applicable to the KE Holdings hiring assessment test, identifying potential compliance risks or opportunities highlighted by the data, and consulting with compliance experts when necessary. Professionals should always err on the side of caution, conducting thorough investigations before implementing changes based on performance metrics, and ensuring that all actions are demonstrably compliant and ethically sound. Question 6. Market research demonstrates that a competitor is gaining significant traction in a new product segment. To inform KE Holdings' strategic response, a junior analyst is tasked with understanding the competitor's pricing strategy and key client acquisition tactics. The analyst has an opportunity to attend an industry conference where representatives from the competitor will be present. Which of the following represents the most appropriate and ethically sound approach for the analyst to gather this information? Option A. Focus on gathering publicly available information such as press releases, investor reports, and industry news articles about the competitor's new product launch and market performance. Option B. Rely on informal conversations and rumors heard from other industry attendees at the conference to piece together the competitor's pricing and client acquisition methods. Option C. Approach competitor representatives directly and openly state that they are from KE Holdings and are seeking to understand their competitive strategy to inform KE Holdings' own market positioning. Option D. Discreetly engage with competitor representatives at the conference, posing as a potential client interested in their new product, to elicit details about their pricing structure and how they are securing new business. Correct answer is D. Discreetly engage with competitor representatives at the conference, posing as a potential client interested in their new product, to elicit details about their pricing structure and how they are securing new business. Explanation. This scenario presents a professional challenge because it requires an individual to balance the pursuit of new business opportunities with the stringent ethical and regulatory obligations of the financial services industry. Specifically within the context of the KE Holdings hiring assessment tests implied jurisdiction, which we will assume aligns with common financial regulatory principles for this exercise, focusing on integrity and client best interests. The core tension lies in how to ethically and effectively gather competitive intelligence without crossing the line into misrepresentation or unfair advantage. Correct approach represents best professional practice because it prioritizes transparency, integrity, and adherence to regulatory expectations regarding fair competition and client confidentiality. It involves a proactive and ethical method of understanding market dynamics by leveraging publicly available information and engaging in legitimate, disclosed business development activities. This aligns with the principle of acting with due skill, care, and diligence, and maintaining the highest standards of integrity. An incorrect approach that involves misrepresenting oneself or the firm's intentions to extract confidential information would constitute a serious regulatory and ethical failure. This could be viewed as deceptive practice, potentially violating rules against misleading conduct and undermining trust within the financial markets. Furthermore, attempting to solicit proprietary information under false pretenses could lead to legal repercussions and severe reputational damage for both the individual and KE Holdings. Another incorrect approach, such as solely relying on unsubstantiated rumors or gossip, fails to meet the standard of due diligence and could lead to flawed strategic decisions based on unreliable data, potentially exposing the firm to undue risk. The professional decision-making process for similar situations should involve a clear framework. 1. Identify the objective. What information is needed and why? 2. Assess ethical boundaries. What are the potential ethical implications of different information-gathering methods? 3. Consult regulatory guidelines. What specific rules or principles govern the proposed actions? 4. Prioritize transparency and honesty. Can the objective be achieved through open and legitimate means? 5. Evaluate risk. What are the potential legal, regulatory, and reputational risks associated with each approach? 6. Seek guidance if uncertain. When in doubt, consult with compliance or legal departments. Question 7. The control framework reveals a potential gap in the segregation of duties within the accounts payable department, where a single individual has the authority to both approve invoices and initiate payments. While management expresses confidence that existing informal checks and balances mitigate this risk, internal audit has not independently verified the effectiveness of these informal measures. Which of the following approaches best addresses this control deficiency in accordance with best professional practice and regulatory expectations? Option A. Implement a rapid, high-level review of the process, focusing on identifying obvious errors rather than systematically testing the control effectiveness, with a plan to address any significant findings at a later date. Option B. Rely on the department head's verbal confirmation that no fraudulent activity has occurred, concluding that the risk is negligible and no further action is required. Option C. Conduct a formal, independent assessment of the segregation of duties risk, including detailed testing of the existing informal controls and recommending specific procedural changes or system enhancements to address the identified gap. Option D. Accept management's assurance regarding the informal checks and balances, assuming that the perceived efficiency of the current process outweighs the need for formal remediation. The correct answer is C. Conduct a formal, independent assessment of the segregation of duties risk, including detailed testing of the existing informal controls and recommending specific procedural changes or system enhancements to address the identified gap. Explanation. This scenario presents a professional challenge due to the inherent tension between achieving business objectives and maintaining robust internal controls. The pressure to meet performance targets can lead individuals to overlook or rationalize control deficiencies, creating a risk of non-compliance and reputational damage. Careful judgment is required to balance these competing demands, ensuring that ethical considerations and regulatory adherence are not compromised in the pursuit of financial success. The correct approach represents best professional practice because it prioritizes a thorough and objective assessment of the control framework's effectiveness. By engaging independent internal audit and seeking external validation where necessary, the company demonstrates a commitment to transparency and accountability. This aligns with the principles of good corporate governance, which mandate that management establish and maintain adequate internal controls to safeguard assets, ensure the accuracy of financial reporting, and promote operational efficiency. Adherence to these principles is often reinforced by regulatory requirements that expect a proactive and diligent approach to risk management and control assessment. An incorrect approach that focuses solely on the perceived efficiency of existing processes without independent verification fails to acknowledge the potential for bias and oversight. This can lead to a false sense of security and leave the organization vulnerable to undetected control weaknesses. Such an approach risks violating regulatory expectations that require objective assurance over control effectiveness, potentially leading to sanctions or penalties if significant control failures are later discovered. Another incorrect approach that relies on anecdotal evidence or informal assurances from department heads bypasses established control assessment methodologies. This is professionally unacceptable, as it lacks the rigor and documentation necessary for a reliable evaluation. It can result in a failure to identify systemic issues and may contravene regulations that mandate formal internal control assessments and reporting. A further incorrect approach that prioritizes speed over thoroughness in control testing, even with the intention of addressing issues later, is also professionally unsound. This can lead to the premature conclusion that controls are effective when they are not, potentially exposing the organization to immediate risks. It undermines the principle of timely and accurate reporting on control environments, which is a cornerstone of regulatory compliance and investor confidence. The professional decision-making process for similar situations should involve a structured approach to control evaluation. This includes clearly defining the scope and objectives of the assessment, utilizing established control frameworks and testing methodologies, ensuring independence and objectivity in the evaluation process, documenting all findings and recommendations thoroughly, and establishing clear lines of accountability for remediation. Professionals must always consider the regulatory landscape and ethical obligations, ensuring that their actions contribute to a strong and sustainable control environment. Question 8. Cost-benefit analysis shows that a new trading strategy could significantly increase profitability for KE Holdings, but it involves leveraging complex derivative instruments in a way that might create a misleading impression of market activity if not carefully managed. Option A. Proceed with the strategy, but only disclose the potential risks to shareholders after the profitability has been realized. Option B. Decline the strategy solely based on the cost-benefit analysis, without further investigation into its regulatory compliance or potential for mitigation. Option C. Immediately implement the strategy to capitalize on the identified profit potential, assuming that any market perception issues can be addressed reactively. Option D. Implement the strategy after a thorough review by the compliance and legal departments to ensure it adheres to all relevant regulations and ethical guidelines, with ongoing monitoring for any unintended market impact. Correct answer is D. Implement the strategy after a thorough review by the compliance and legal departments to ensure it adheres to all relevant regulations and ethical guidelines, with ongoing monitoring for any unintended market impact. Explanation. This scenario presents a professional challenge because it requires balancing potential financial gains with the ethical obligation to ensure fair and transparent market practices, as mandated by the KE Holdings Hiring Assessment Tests regulatory framework. The core tension lies in identifying whether a proposed strategy, while seemingly beneficial from a cost-benefit perspective, could inadvertently lead to market manipulation or insider trading, which are strictly prohibited. Careful judgment is required to discern the line between legitimate business strategy and prohibited conduct. The correct approach represents best professional practice because it prioritizes adherence to the spirit and letter of the regulatory framework. This involves a proactive assessment of potential market impact and a commitment to transparency. By seeking independent legal and compliance review, professionals demonstrate a commitment to upholding regulatory integrity and preventing any actions that could be construed as market abuse. This aligns with the ethical duty to act in the best interests of the market and its participants, fostering trust and confidence. An incorrect approach that focuses solely on maximizing short-term financial gains without considering regulatory implications fails to uphold the duty of care and diligence expected of professionals. This could lead to violations of regulations designed to prevent market manipulation, such as those prohibiting the dissemination of misleading information or engaging in transactions that create a false impression of market activity. Another incorrect approach, which involves proceeding without adequate due diligence on the regulatory implications, demonstrates a lack of professional skepticism and a disregard for potential legal and reputational risks. This can result in unintentional breaches of regulations concerning market integrity and fair dealing. The professional decision-making process for similar situations should involve a structured approach. First, thoroughly understand the proposed strategy and its potential market impact. Second, identify all relevant regulations and guidelines applicable to the situation. Third, conduct a comprehensive risk assessment, considering both financial and regulatory/ethical risks. Fourth, consult with legal and compliance departments to obtain expert advice. Finally, make a decision that demonstrably prioritizes regulatory compliance and ethical conduct, even if it means forgoing a potentially lucrative but risky opportunity. Question 9. Market research demonstrates that a junior analyst at KE Holdings has inadvertently accessed a draft research report containing material non-public information about a significant upcoming merger. The analyst is unsure how to proceed, recognizing the sensitive nature of the document. Which of the following actions best represents the appropriate professional and regulatory response in this situation? Option A. Discreetly use the insights from the draft report to refine personal investment strategies. Option B. Proceed with the analysis as planned, assuming the information will be made public soon and therefore is no longer considered non-public. Option C. Immediately report the access and nature of the information to the firm's compliance department and await their specific instructions before taking any further action. Option D. Share the draft report with a senior colleague in a different department to get their opinion on its potential market impact. Correct answer is C. Immediately report the access and nature of the information to the firm's compliance department and await their specific instructions before taking any further action. Explanation. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the need to ensure market integrity and prevent potential insider trading. The KE Holdings hiring assessment test likely emphasizes adherence to regulatory frameworks designed to protect investors and maintain fair markets. A key aspect of this is the responsible handling of non-public information. The correct approach represents best professional practice because it prioritizes compliance with regulatory obligations and ethical standards. Specifically, it aligns with principles of market abuse regulation, which prohibit the disclosure of inside information and the encouragement of insider dealing. By seeking guidance from the compliance department, the individual demonstrates a commitment to understanding and adhering to the firm's policies and relevant regulations, thereby safeguarding both the firm and the market from potential harm. This proactive step ensures that any action taken is informed by expert knowledge of legal and ethical boundaries. An incorrect approach that involves sharing the information with a trusted colleague, even with the intention of seeking their opinion, represents a significant regulatory and ethical failure. This action breaches client confidentiality and creates a substantial risk of inside information being disseminated, potentially leading to insider trading. It bypasses the established channels for seeking compliance advice and demonstrates a lack of understanding of the severe consequences associated with the misuse of non-public information. Another incorrect approach, such as ignoring the information and proceeding as if it were public, is also professionally unacceptable. This demonstrates a disregard for the potential impact of the information and a failure to exercise due diligence. It could lead to the firm acting on incomplete or misleading information, potentially causing financial detriment to clients or the firm itself, and failing to uphold the duty of care expected of professionals. Finally, an incorrect approach that involves discreetly using the information to inform investment decisions, even if not directly sharing it, is a clear violation of insider trading regulations. This constitutes an attempt to gain an unfair advantage through the possession of material non-public information, undermining market fairness and trust. The professional decision-making process for similar situations should involve a clear hierarchy of actions. First, recognize the potential sensitivity of the information. Second, immediately consult the firm's compliance department or legal counsel for guidance. Third, strictly adhere to their advice. And fourth, document all interactions and decisions related to the handling of such information. This structured approach ensures that all actions are compliant, ethical, and protect the integrity of the market and the firm. Question 10. The efficiency study reveals that a significant portion of operational costs can be reduced by streamlining the client onboarding process through a less rigorous, automated verification system. This system would reduce the time taken to onboard new clients by 40%, but may not capture all the nuanced risk indicators that a manual review currently identifies. Which of the following represents the most professionally responsible approach to this finding? Option A. Conduct a comprehensive risk assessment of the proposed automated system in collaboration with the compliance department to ensure it meets all regulatory requirements for client due diligence before considering implementation. Option B. Deploy the automated verification system, but instruct the compliance team to conduct post-implementation audits only on a sample of onboarded clients to manage workload. Option C. Implement the automated verification system immediately to realize cost savings, with a plan to address any compliance issues that may arise later. Option D. Reject the automated verification system outright, as any deviation from current manual processes poses a potential compliance risk. The correct answer is C. Implement the automated verification system immediately to realize cost savings, with a plan to address any compliance issues that may arise later. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent tension between achieving operational efficiency and maintaining robust compliance with regulatory requirements. The pressure to reduce costs and streamline processes can inadvertently lead to shortcuts that compromise the integrity of data or the thoroughness of client due diligence, potentially exposing the firm to significant regulatory penalties and reputational damage. Careful judgment is required to balance these competing demands. Correct approach analysis. The correct approach prioritizes the integrity of the compliance framework and adherence to regulatory mandates. This involves a systematic review of the efficiency study's findings to identify any proposed changes that might weaken existing controls or introduce new risks. It necessitates engaging with the compliance department to assess the regulatory implications of any proposed efficiencies, ensuring that all changes are vetted against relevant laws and guidelines before implementation. This upholds the firm's commitment to regulatory compliance, which is a fundamental ethical and legal obligation, and safeguards against future enforcement actions. Incorrect approaches analysis. One incorrect approach involves immediately implementing the efficiency recommendations without a thorough compliance review. This demonstrates a failure to adhere to the principle of compliance by design, where regulatory considerations are integrated into operational planning. Such an approach risks violating regulations that mandate specific procedures for client onboarding, transaction monitoring, or data handling, leading to potential fines and sanctions. Another incorrect approach is to dismiss the efficiency study entirely due to potential compliance concerns without a detailed assessment. This represents a failure to proactively seek improvements and can lead to missed opportunities for legitimate cost savings. Ethically, it can be seen as a lack of diligence in managing firm resources. However, from a regulatory perspective, it is less severe than actively compromising compliance. A third incorrect approach is to implement efficiencies that rely on automated systems without ensuring these systems are adequately configured to meet all regulatory reporting and data retention requirements. This is a critical failure, as automated systems can create a false sense of security while masking underlying compliance gaps. It violates regulations that require accurate and complete record-keeping and reporting, potentially leading to severe penalties for non-compliance. Professional reasoning. Professionals should adopt a risk-based approach when evaluating efficiency initiatives. This involves first identifying potential compliance risks associated with proposed changes, then assessing the likelihood and impact of those risks. Subsequently, mitigation strategies should be developed and implemented to address any identified risks. Collaboration between operational teams and the compliance department is crucial throughout this process to ensure that efficiency gains do not come at the expense of regulatory adherence. A proactive and integrated approach to compliance management is the cornerstone of sound professional practice. Question 11. Operational review demonstrates that the firm's automated trade reconciliation system is experiencing significant delays due to a recent surge in transaction volumes, creating a backlog of unreconciled trades. Management is concerned about the impact on operational efficiency and the potential for missed discrepancies. What is the most appropriate course of action to address this implementation challenge while adhering to regulatory requirements for record keeping and internal controls? Option A. Shift all backlog reconciliation to a purely manual process, abandoning the automated system for the backlog to ensure thoroughness, even if it is less efficient. Option B. Defer the reconciliation of all backlog transactions until the system's capacity issues are fully resolved, without implementing any interim manual checks. Option C. Temporarily disable certain automated reconciliation checks for a defined period to allow the system to catch up with the current transaction flow. Option D. Implement a temporary risk-based approach to clear the backlog, prioritizing high-value and complex transactions for immediate manual review, while concurrently developing a plan to reprocess the remaining transactions through the automated system once capacity is restored, and enhancing monitoring of the reconciliation process. Correct answer is D. Implement a temporary risk-based approach to clear the backlog, prioritizing high-value and complex transactions for immediate manual review, while concurrently developing a plan to reprocess the remaining transactions through the automated system once capacity is restored, and enhancing monitoring of the reconciliation process. Explanation. Scenario analysis. This scenario presents a challenge in balancing the need for efficient data processing with the imperative to maintain data integrity and comply with regulatory requirements for record keeping. The firm is experiencing a surge in transaction volume, leading to potential delays in its automated reconciliation process. The core challenge lies in deciding how to manage this backlog without compromising the accuracy and auditability of financial records, which are subject to strict regulatory oversight. The pressure to clear the backlog quickly could tempt shortcuts, but any deviation from established procedures or regulatory mandates could have severe consequences. Correct approach analysis. The correct approach involves a phased, risk-based strategy to address the backlog while ensuring ongoing compliance. This includes prioritizing the reconciliation of high-risk transactions first, which are typically those with larger values, complex structure, or those involving sensitive client assets. Implementing temporary, manual checks for a defined subset of transactions, coupled with enhanced monitoring and a clear plan for retrospective automated reconciliation, demonstrates a commitment to both operational efficiency and regulatory adherence. This approach acknowledges the immediate pressure, but safeguards against systemic errors and regulatory breaches by maintaining a clear audit trail and a commitment to full reconciliation. It aligns with the principles of robust internal controls and risk management expected by regulatory bodies, ensuring that data integrity is not sacrificed for speed. Incorrect approaches analysis. One incorrect approach involves temporarily disabling certain automated reconciliation checks to speed up processing. This is a significant regulatory and ethical failure. It directly violates the principle of maintaining accurate and complete financial records, as mandated by regulations governing financial institutions. Disabling checks undermines the internal control framework, creating a high risk of undetected errors, fraud, or misstatements. This could lead to severe penalties, reputational damage, and loss of client trust. Another incorrect approach is to simply defer all backlog reconciliation to a later, unspecified date without any interim controls. This demonstrates a disregard for the importance of timely and accurate financial reporting. Regulatory frameworks typically require that financial records be maintained in a current and verifiable state. Postponing reconciliation indefinitely creates an unacceptable level of risk, making it impossible to identify discrepancies or potential issues in a timely manner. This failure to manage operational risks proactively is a breach of professional duty and regulatory expectation. A third incorrect approach is to rely solely on manual reconciliation for all backlog transactions without any plan to reintegrate them into the automated system. While manual reconciliation can be thorough, it is prone to human error, is time-consuming, and may not provide the same level of auditability as an automated system. Furthermore, it fails to address the underlying issue of the automated system's capacity, leaving the firm vulnerable to future backlogs. This approach is inefficient and does not demonstrate a commitment to a sustainable and compliant operational process. Professional reasoning. Professionals facing such implementation challenges must first assess the nature and magnitude of the backlog and its potential impact on regulatory compliance and business operations. A thorough risk assessment is crucial to identify which transactions pose the greatest risk if not reconciled promptly. The decision-making process should then involve evaluating potential solutions against regulatory requirements, internal policies, and ethical obligations. Prioritizing solutions that maintain data integrity, ensure auditability, and mitigate risks is paramount. Communication with relevant stakeholders, including compliance and senior management, is essential to ensure transparency and obtain necessary approvals for any deviations from standard procedures. The ultimate goal is to implement a solution that is both operationally effective and demonstrably compliant with all applicable regulations. Question 12. Risk assessment procedures indicate that a significant piece of market-moving information, crucial for an upcoming earnings announcement, is facing unexpected delays in its final verification due to the sudden illness of a key analyst and the complexity of the underlying data. The deadline for public disclosure is rapidly approaching, and the firm is under pressure to release the information to meet market expectations. What is the most appropriate course of action for the firm to ensure compliance with regulatory requirements while managing the disclosure of this sensitive information? Option A. Share the preliminary findings with a select group of trusted institutional investors to manage their expectations, while preparing for a broader public release. Option B. Postpone the public disclosure indefinitely until all internal verification processes are fully completed, without informing any external parties of the delay. Option C. Immediately contact the relevant regulatory body to explain the situation and request guidance, or a potential extension for the disclosure, while continuing to expedite the internal verification process. Option D. Proceed with the disclosure of the information as soon as a preliminary version is available, even if it has not undergone the full verification process, to avoid market speculation. The correct answer is C. Immediately contact the relevant regulatory body to explain the situation and request guidance or a potential extension for the disclosure, while continuing to expedite the internal verification process. Explanation. Scenario analysis. This scenario presents a challenge in balancing the need for timely information dissemination with the regulatory obligation to ensure accuracy and prevent market abuse. The firm is under pressure to release potentially market-moving information quickly, but the internal review process is encountering unexpected delays due to the complexity of the data and the unavailability of key personnel. This creates a tension between commercial imperatives and compliance requirements, demanding careful judgment to avoid both regulatory breaches and reputational damage. Correct approach analysis. The correct approach prioritizes regulatory compliance and market integrity. By engaging with the relevant regulatory body to seek an extension or clarification on disclosure timing, the firm demonstrates a proactive and responsible attitude. This aligns with the principles of transparency and fairness expected of financial institutions. It allows for a thorough review to ensure the accuracy of the information before public release, thereby mitigating the risk of misleading the market or engaging in insider dealing. This approach upholds the spirit and letter of regulations designed to protect investors and maintain orderly markets. Incorrect approaches analysis. One incorrect approach involves proceeding with the disclosure without completing the internal review. This would be a direct violation of regulations requiring accurate and complete information to be disseminated. It exposes the firm and its employees to significant legal and financial penalties, including fines and reputational damage. Furthermore, it could lead to accusations of market manipulation or the dissemination of misleading information, undermining investor confidence. Another incorrect approach is to delay disclosure indefinitely without communicating with regulators or stakeholders. This failure to provide timely information, especially when it is likely to be market-moving, can also be a regulatory breach. It can create an information vacuum, leading to speculation and potentially unfair trading practices. It also signals a lack of transparency and can damage the firm's credibility. A third incorrect approach is to selectively disclose information to certain parties before the general public. This constitutes selective disclosure and is a clear breach of market abuse regulations, specifically prohibitions against insider dealing and the unfair dissemination of information. It creates an uneven playing field for investors and can lead to severe sanctions. Professional reasoning. Professionals facing such a dilemma should first assess the materiality of the information and the potential impact of any delay. They should then consult internal compliance and legal teams to understand the precise regulatory obligations. If there is a genuine risk of non-compliance due to unforeseen circumstances, the most professional course of action is to proactively engage with the relevant regulatory authority. This demonstrates good faith and a commitment to regulatory adherence. Documenting all communications and decisions is crucial for demonstrating due diligence. Question 13. Process analysis reveals that KE Holdings is planning a significant upgrade to its client data processing system. This upgrade aims to enhance efficiency and introduce new analytical capabilities. However, the project timeline is aggressive, and there is pressure to deploy the new system rapidly. Primary concern is ensuring that sensitive client financial and personal data remains secure and compliant with all relevant data protection regulations throughout the transition and in the new system's operation. Which of the following approaches best balances the need for efficient system implementation with the absolute priority of safeguarding client data and ensuring regulatory compliance? Option A. Prioritize the technical functionality of the new system, deferring detailed data security and compliance reviews until after the initial deployment to avoid project delays. Option B. Immediately deploy the new system across all client segments to realize efficiency gains as quickly as possible, relying on existing security measures which are assumed to be sufficient. Option C. Conduct comprehensive security and compliance testing in a segregated pre-production environment, followed by a phased rollout of the new system to different client segments with continuous monitoring and auditing. Option D. Implement the new system using a minimal set of security features to expedite the process, with plans to address more robust security measures in a subsequent update. The correct answer is C. Conduct comprehensive security and compliance testing in a segregated pre-production environment, followed by a phased rollout of the new system to different client segments, with continuous monitoring and auditing. Explanation. Scenario analysis. This scenario presents a common implementation challenge in financial services, balancing the need for efficient data processing with the imperative of regulatory compliance and client confidentiality. The challenge lies in identifying and mitigating risks associated with handling sensitive client information during a system upgrade. Professionals must exercise careful judgment to ensure that the chosen approach not only achieves the technical objectives, but also upholds legal and ethical obligations. The pressure to meet project deadlines can often create tension with the thoroughness required for robust risk management. Correct approach analysis. The correct approach involves a phased, risk-based implementation of the new data processing system. This strategy prioritizes data security and compliance by conducting thorough testing in a controlled environment before full deployment. It aligns with regulatory expectations for data protection and privacy, such as those found in the UK's Data Protection Act 2018 and the General Data Protection Regulation, GDPR, which mandate appropriate technical and organizational measures to protect personal data. A phased rollout allows for the identification and remediation of any vulnerabilities or compliance gaps in a low-risk setting, minimizing the potential for data breaches or regulatory noncompliance. This approach demonstrates due diligence and a commitment to responsible data handling, which are fundamental ethical and professional standards in the financial sector. Incorrect approaches analysis. One incorrect approach involves proceeding with a full, immediate rollout of the new system without adequate testing of its data handling capabilities. This would represent a significant regulatory failure, potentially violating data protection laws by exposing sensitive client information to undue risk. Ethically, it breaches the duty of care owed to clients. Another incorrect approach is to delay the implementation indefinitely due to minor, unquantified risks, which could lead to operational inefficiencies and a failure to meet business objectives, potentially contravening the firm's duty to operate effectively and competitively. A third incorrect approach is to bypass established data security protocols to expedite the process, which is a direct violation of regulatory requirements and ethical principles, exposing the firm to severe penalties and reputational damage. Professional reasoning. professionals should adopt a structured, risk-aware decision-making process. This involves 1. Identifying all potential risks associated with the implementation, including data security, regulatory compliance, and operational impact. 2. Assessing the likelihood and severity of each risk. 3. Developing mitigation strategies for high-priority risks. 4. Prioritizing a phased approach that allows for iterative testing and validation in secure environments. 5. Ensuring all actions are documented and align with internal policies and external regulations. This systematic approach ensures that technical objectives are met without compromising client trust or regulatory standing. Question 14. The audit findings indicate that a junior analyst inadvertently shared a client's confidential financial projections with an external vendor without proper authorization or a non-disclosure agreement in place. The firm's data security policy clearly outlines the procedures for sharing sensitive client information. What is the most appropriate immediate course of action for the compliance officer? Option A. Immediately terminate the junior analyst's employment and notify the client of a potential data breach without further investigation. Option B. Report the incident to the relevant regulatory body as a confirmed data breach and await their instructions before taking any internal action. Option C. Initiate an immediate internal investigation to determine the full extent of the data exposure, review the analyst's actions against the firm's data security policy, and implement immediate corrective measures to prevent future occurrences, including enhanced training and stricter access controls. Option D. Document the incident in the audit report and advise the junior analyst to be more careful in the future, assuming the vendor is trustworthy and no explicit harm has occurred. Correct answer is C. Initiate an immediate internal investigation to determine the full extent of the data exposure, review the analyst's actions against the firm's data security policy, and implement immediate corrective measures to prevent future occurrences, including enhanced training and stricter access controls. Explanation. The audit findings indicate a potential breakdown in the firm's internal controls related to the handling of sensitive client information. This scenario is professionally challenging because it requires immediate and decisive action to rectify the identified weaknesses, while also considering the potential reputational damage and regulatory scrutiny. The firm must balance the need for swift remediation with the imperative to maintain client trust and adhere to all applicable regulations. The correct approach involves a thorough investigation to understand the root cause of the control deficiencies, followed by the implementation of robust corrective actions. This demonstrates best professional practice by proactively addressing identified risks, safeguarding client data, and ensuring compliance with data protection regulations. It prioritizes the integrity of the firm's operations and its commitment to client confidentiality. An incorrect approach that involves merely documenting the findings without implementing corrective actions would be a significant regulatory and ethical failure. This inaction would expose the firm to continued risks, potential data breaches, and non-compliance with data protection laws, leading to severe penalties and loss of client confidence. Another incorrect approach, such as attempting to conceal the findings from senior management or regulators, constitutes a serious ethical breach and a violation of disclosure obligations. This would undermine the principles of transparency and accountability, leading to severe disciplinary actions and legal consequences. A third incorrect approach, focusing solely on superficial fixes without addressing the underlying systemic issues, would fail to provide lasting protection and would likely result in recurring control failures, demonstrating a lack of due diligence and professional responsibility. Professionals should approach such situations by first conducting a comprehensive risk assessment to understand the scope and impact of the control deficiencies. This should be followed by developing a detailed remediation plan with clear timelines and assigned responsibilities. Regular monitoring and reporting on the progress of remediation are crucial to ensure effectiveness and demonstrate accountability to stakeholders and regulators. Question 15. Assessment of the most appropriate strategy for implementing a new client onboarding and transaction monitoring system at KE Holdings, considering the need to balance operational efficiency with stringent regulatory compliance requirements. Option A. Expedite the deployment by skipping detailed user acceptance testing, relying on the vendor's pre-implementation compliance checks. Option B. Implement the system in phases, starting with core compliance functionalities, followed by a comprehensive validation against all relevant regulatory frameworks and thorough user acceptance testing before full rollout. Option C. Prioritize the system with the lowest upfront licensing cost, assuming vendor assurances of regulatory compliance are sufficient for initial deployment. Option D. Focus on implementing advanced, non-essential features that enhance user interface aesthetics and workflow speed, deferring in-depth regulatory validation to a later stage. The correct answer is B. Implement the system in phases, starting with core compliance functionalities, followed by a comprehensive validation against all relevant regulatory frameworks and thorough user acceptance testing before full rollout. Explanation. Scenario analysis. This scenario presents a challenge in implementing new compliance software within a financial institution. The difficulty lies in balancing the immediate need for operational efficiency and cost-effectiveness with the long-term imperative of robust regulatory adherence and data integrity. The pressure to deploy quickly and within budget can lead to shortcuts that compromise compliance, creating a significant professional challenge requiring careful judgment. Correct approach analysis. The correct approach prioritizes a phased implementation that includes thorough testing and validation against relevant regulatory requirements. This aligns with the principle of fit and proper conduct expected of financial institutions and their employees. Specifically, it ensures that the new system accurately captures, processes, and reports data in a manner compliant with KE Holdings' regulatory obligations, such as those pertaining to anti-money laundering (AML), Know Your Customer (KIC), and market abuse surveillance. This methodical approach minimizes the risk of regulatory breaches, reputational damage, and potential penalties, representing best professional practice by embedding compliance from the outset. Incorrect approaches analysis. An approach that focuses solely on the lowest initial cost without adequate consideration for the system's ability to meet regulatory reporting standards is professionally unacceptable. This could lead to noncompliance with data accuracy and reporting requirements, potentially violating regulations that mandate precise financial record-keeping and timely submission of information to regulatory bodies. An approach that bypasses comprehensive user acceptance testing, UAT, to expedite deployment, even if the vendor claims compliance, is also professionally flawed. This neglects the critical step of verifying that the system functions as intended within the specific operational context of KE Holdings and can accurately reflect regulatory requirements in practice. Failure to do so could result in undetected errors that lead to regulatory noncompliance. An approach that prioritizes features deemed nice to have over core compliance functionalities, even if it appears to enhance user experience, is professionally unsound. This misallocation of resources and focus can result in a system that is less effective in meeting essential regulatory obligations, creating a higher risk of compliance failures. Professional reasoning. Professionals should adopt a risk-based approach, identifying key regulatory requirements and ensuring the chosen solution demonstrably meets them. A structured implementation plan, including pilot phases, rigorous testing, and ongoing monitoring, is crucial. Stakeholder engagement, particularly with compliance and legal departments, is vital to ensure all regulatory perspectives are considered. The decision-making process should weigh the potential benefits of speed and cost savings against the significant risks of non-compliance and its associated consequences. Question 16. Comparative studies suggest that implementing robust data anonymization for analytical purposes presents significant challenges. KE Holdings is developing a new analytics platform that will process large volumes of customer data. The project team is considering different strategies for anonymizing this data to comply with data protection regulations, while ensuring the data remains useful for generating business insights. Which of the following approaches best balances regulatory compliance with analytical utility? Option A. Prioritize the preservation of maximum data detail for analytical depth, using only basic masking of obvious identifiers, with the understanding that further privacy measures can be retroactively applied if issues are identified. Option B. Implement a multi-stage anonymization process that includes techniques like generalization, suppression, and perturbation, followed by independent validation of the anonymized dataset's privacy and utility, all governed by a comprehensive data governance policy. Option C. Outsource the anonymization process to a third-party vendor without conducting internal due diligence on their specific methodologies or validation procedures, relying solely on their contractual assurances of compliance. Option D. Apply a single, widely recognized anonymization algorithm to the raw data and assume its effectiveness, with a plan to address any privacy concerns that may arise post-analysis. Correct answer is B. Implement a multi-stage anonymization process that includes techniques like generalization, suppression, and perturbation, followed by independent validation of the anonymized dataset's privacy and utility, all governed by a comprehensive data governance policy. Explanation. This scenario presents a common implementation challenge in financial services, balancing the need for efficient data processing with the imperative of regulatory compliance and data privacy. The challenge lies in the potential for data anonymization techniques to inadvertently compromise the integrity or utility of the data for analytical purposes, or conversely, to fail in adequately protecting sensitive information. Professionals must navigate the technical complexities of anonymization while adhering to strict legal and ethical obligations regarding data handling. The correct approach, which involves a multi-stage process of data anonymization with ongoing validation and a clear data governance framework, represents best professional practice because it directly addresses the core requirements of data protection regulations. This approach prioritizes the robust removal or obfuscation of personally identifiable information, PI, before data is used for analysis, thereby minimizing the risk of breaches and noncompliance. The inclusion of validation steps ensures that the anonymization is effective and that the data remains fit for its intended analytical purpose, aligning with principles of data minimization and purpose limitation. A strong data governance framework provides the necessary oversight, accountability, and documented procedures to ensure consistent and compliant data handling. An incorrect approach that relies solely on a single, unvalidated anonymization technique is professionally unacceptable due to significant regulatory and ethical failures. Such an approach risks inadequate protection of PII, leading to potential breaches of data privacy laws. For instance, if the chosen technique is insufficient, sensitive data could be exposed, resulting in severe penalties, reputational damage, and loss of client trust. Ethically, it demonstrates a disregard for the fundamental right to privacy. Another incorrect approach that prioritizes data utility over robust anonymization, even with the intention of later addressing privacy concerns, is also professionally flawed. This approach creates an unacceptable level of risk by exposing sensitive data in its more identifiable form. The subsequent attempt to anonymize or mitigate risks is reactive rather than proactive and may not fully rectify the initial exposure. This violates the principle of data protection by design and default, which mandates that privacy considerations are integrated from the outset. The professional decision-making process for similar situations should involve a thorough risk assessment of data types and intended uses, followed by the selection and implementation of appropriate anonymization techniques. This should be complemented by rigorous testing and validation to confirm effectiveness. Establishing clear data governance policies, including data retention, access controls, and incident response plans, is crucial. Continuous monitoring and periodic review of anonymization processes are also essential to adapt to evolving threats and regulatory requirements. Question 17. The assessment process reveals that the firm's current operational procedures for handling client funds do not fully align with the newly introduced client asset protection rules. The firm must implement these rules effectively and efficiently. Which of the following approaches best balances regulatory compliance, operational integrity, and client service during this implementation phase? Option A. Postpone the implementation of the new rules until the firm has more resources and a clearer understanding of the long-term implications, while continuing with existing procedures. Option B. Implement the new rules immediately across all departments, making ad hoc adjustments as issues arise during live operations. Option C. Prioritize implementation only in the most high-risk areas, deferring changes in less critical operational touchpoints until a later date. Option D. Develop a detailed implementation plan that includes a thorough impact assessment, system modifications, comprehensive staff training, and a phased rollout with pilot testing before full deployment. The correct answer is B. Implement the new rules immediately across all departments, making ad hoc adjustments as issues arise during live operations. Explanation. Scenario analysis. This scenario presents a common implementation challenge where a new regulatory requirement, the Client Asset Protection Rules, necessitates significant changes to existing operational procedures for handling client funds. The challenge lies in balancing the urgency of compliance with the practicalities of system integration, staff training, and potential disruption to client services. A rushed implementation could lead to errors, breaches of the new rules, and damage to client trust and the firm's reputation. Conversely, delaying implementation risks non-compliance and potential regulatory sanctions. Correct approach analysis. The correct approach prioritizes a phased implementation strategy, starting with a thorough impact assessment and detailed planning. This involves understanding precisely how the client asset protection rules affect current processes, identifying necessary system modifications, and developing a comprehensive training program for all relevant staff. A pilot testing phase before full rollout allows for the identification and rectification of unforeseen issues in a controlled environment. This methodical approach ensures that the firm not only meets the regulatory requirements, but does so in a way that minimizes operational risk and maintains client confidence. It aligns with the principles of robust risk management and due diligence expected under financial services regulation, ensuring that client assets are protected effectively and that the firm operates within legal and ethical boundaries. Incorrect approaches analysis. One incorrect approach involves immediate, full-scale implementation without adequate planning or testing. This is professionally unacceptable because it significantly increases the risk of operational errors, data breaches, and non-compliance with the client asset protection rules. It demonstrates a failure to conduct proper risk assessment and due diligence, potentially exposing client assets to undue risk and leading to regulatory penalties. Another incorrect approach is to delay implementation indefinitely, citing resource constraints or the complexity of the changes. This is ethically and regulatorily unsound. Financial services firms have a duty to comply with all applicable laws and regulations. Procrastination in implementing critical client asset protection measures constitutes a breach of this duty, potentially leading to severe regulatory sanctions, fines, and reputational damage. It also fails to uphold the firm's fiduciary responsibility to protect client assets. A third incorrect approach is to implement the changes only in the most critical areas, neglecting less obvious but still relevant operational touchpoints. While efficiency is important, the client asset protection rules are likely designed to cover all aspects of client asset handling. A piecemeal approach risks creating loopholes or inconsistencies that could still lead to breaches, undermining the overall objective of the regulation, and failing to provide comprehensive protection for client assets. Professional reasoning. Professionals facing such implementation challenges should adopt a structured, risk-based approach. This involves 1. Understanding the regulatory mandate thoroughly. 2. Conducting a comprehensive impact assessment of the new requirements on existing operations. 3. Developing a detailed implementation plan that includes timelines, resource allocation, system changes, and training. 4. Incorporating robust testing and pilot phases. 5. Establishing clear communication channels with all stakeholders, including staff and potentially clients. 6. Continuously monitoring the implementation process and post-implementation performance to ensure ongoing compliance and identify any emergent issues. This systematic process ensures that regulatory obligations are met while safeguarding the firm's operational integrity and client interests. Question 18. To address the challenge of a high net worth client proposing a complex offshore investment structure with significant tax deferral benefits, which of the following represents the most professionally responsible course of action for a financial advisory firm? Option A. Proceed with implementing the offshore structure as proposed by the client, assuming their legal counsel has deemed it compliant. Option B. Advise the client to seek advice from a specialist offshore tax advisor without conducting any internal review or offering any alternative compliance strategies. Option C. Immediately reject the client's proposal due to the inherent complexity and potential for regulatory scrutiny associated with offshore structures. Option D. Conduct an independent and comprehensive review of the proposed structure, assessing its economic substance, commercial rationale, and adherence to all relevant tax legislation and anti-avoidance rules, while engaging in transparent communication with the client regarding potential risks and alternative compliance strategies. The correct answer is A. Proceed with implementing the offshore structure as proposed by the client, assuming their legal counsel has deemed it compliant. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's desire for aggressive tax planning and the firm's ethical and regulatory obligations. The challenge lies in balancing client service with the imperative to uphold the integrity of the financial system and comply with tax laws. Professionals must exercise sound judgment to identify when tax planning strategies cross the line from legitimate tax mitigation into evasion or aggressive avoidance that could be challenged by tax authorities. The pressure to retain a high-value client can also create an ethical dilemma, requiring a strong commitment to professional standards. Correct approach analysis. The correct approach involves a thorough review of the proposed tax strategy, considering its economic substance, commercial rationale, and compliance with all relevant tax legislation and guidance. This includes assessing whether the strategy is designed primarily to achieve a tax benefit without a genuine commercial purpose, which could render it vulnerable to challenge. Best professional practice dictates a proactive stance, engaging in open dialogue with the client about the risks and potential consequences, and advising on alternative compliance strategies. This aligns with the ethical duty to act with integrity and due care, and the regulatory requirement to ensure that advice provided is lawful and does not facilitate noncompliance. The firm must be prepared to decline to implement strategies that are non-compliant or carry an unacceptable level of risk, even if it means losing the client. Incorrect approaches analysis. One incorrect approach involves immediately implementing the client's proposed strategy without independent verification or risk assessment. This fails to uphold the professional duty of due care and integrity. It could lead to the firm facilitating tax evasion or aggressive tax avoidance, which is a direct violation of regulatory frameworks and ethical codes. Such an approach demonstrates a lack of professional skepticism and a failure to act in the best interests of both the client, by exposing them to future penalties and reputational damage, and the wider financial system. Another incorrect approach is to dismiss the client's proposal outright without understanding the underlying commercial objectives or exploring potential compliant alternatives. While caution is necessary, a complete refusal without engagement can be seen as poor client service and a missed opportunity to provide valuable, compliant advice. This approach might stem from an overly risk-averse stance that hinders the firm's ability to offer legitimate tax planning solutions, potentially pushing clients to less reputable advisors. Ethically, it may not fully meet the obligation to provide competent advice. A third incorrect approach is to rely solely on the client's assurance that the strategy is legal and compliant, without conducting independent due diligence. This abdicates the firm's professional responsibility to verify the legality and appropriateness of the advice given. It exposes the firm to significant regulatory and reputational risk if the strategy is later found to be non-compliant. This approach demonstrates a lack of professional skepticism and a failure to adhere to the principles of professional competence and diligence. Professional reasoning. Professionals should adopt a framework that prioritizes compliance and ethical conduct. This involves 1. Understanding the client's objectives and the commercial rationale behind their proposals. 2. Conducting thorough due diligence on any proposed strategy, assessing its economic substance and compliance with all applicable laws and regulations. 3. Engaging in open and honest communication with the client, clearly outlining risks, potential consequences, and alternative compliance strategies. 4. Documenting all advice and decisions meticulously. 5. Being prepared to refuse to implement strategies that are non-compliant or carry an unacceptable level of risk, prioritizing professional integrity over short-term client retention. Question 19. Stakeholder feedback indicates that a long-term client who has consistently followed your investment advice has recently expressed a strong desire to invest a significant portion of their portfolio in a highly speculative, illiquid asset class. The client states they were strongly recommended to do so by a new acquaintance who claims to have insider knowledge of substantial upcoming gains. The client seems very enthusiastic, but has provided little detail about the acquaintance or the specific investment beyond the promise of rapid high returns. What is the most appropriate course of action? Option A. Immediately advise the client that this type of investment is too risky for them and that they should disregard the advice of their new acquaintance, as such schemes are often fraudulent. Option B. Proceed with the investment as requested by the client, as they are an adult and have the right to make their own financial decisions, and your role is to execute their instructions. Option C. Contact the new acquaintance directly to understand their credentials and the basis of their investment recommendation before discussing it further with the client. Option D. Schedule a meeting with the client to thoroughly discuss their financial goals, risk tolerance, and the potential implications of this proposed investment. Independently research the asset class and the specific investment opportunity, and present a balanced view of the risks and potential rewards. Advising against the investment if the due diligence reveals significant concerns or a mismatch with the client's profile. The correct answer is D. Schedule a meeting with the client to thoroughly discuss their financial goals, risk tolerance, and the potential implications of this proposed investment. Independently research the asset class and the specific investment opportunity, and present a balanced view of the risks and potential rewards, advising against the investment if the due diligence reveals significant concerns or a mismatch with the client's profile. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's stated wishes and the potential for that client to be influenced by external, potentially self-serving advice. The core of the dilemma lies in balancing the duty of loyalty and acting in the client's best interest against the client's autonomy and the advisor's obligation to respect their decisions. The advisor must navigate this without overstepping boundaries or appearing to disregard the client's agency, while also upholding their fiduciary responsibilities. The correct approach represents best professional practice because it prioritizes a thorough, objective assessment of the client's situation and the proposed investment. This involves seeking clarification, understanding the rationale behind the client's decision, and independently verifying the information provided by the third party. This aligns with regulatory frameworks that mandate acting in the client's best interest, conducting due diligence, and avoiding conflicts of interest. It upholds the ethical principle of competence and diligence by ensuring that any recommendation or action taken is based on sound judgment and a comprehensive understanding of the risks and benefits involved, rather than simply accepting the client's initial inclination. An incorrect approach that involves immediately proceeding with the client's request without further inquiry would be a significant regulatory and ethical failure. This would violate the duty to act in the client's best interest, as it bypasses the necessary due diligence and risk assessment. Could also lead to a breach of fiduciary duty if the third party's advice is indeed detrimental to the client. Furthermore, it demonstrates a lack of professional skepticism and an abdication of responsibility to provide informed guidance. Another incorrect approach, that of directly confronting the client and dismissing the third party's influence without a structured investigation, risks alienating the client and damaging the professional relationship. While the advisor may suspect undue influence, a confrontational stance without evidence can be perceived as unprofessional and disrespectful of the client's autonomy. This could lead to the client seeking advice elsewhere, potentially from the very source the advisor is concerned about, thereby exacerbating the risk. The professional decision-making process for similar situations should involve a structured approach. 1. Acknowledge and understand the client's stated position. 2. Seek clarification and gather information from the client regarding their reasoning and the source of their information. 3. Conduct independent research and due diligence on any proposed course of action or investment, especially when external advice is involved. 4. Objectively assess the risks and benefits, considering the client's overall financial goals and risk tolerance. 5. Communicate findings and recommendations clearly and professionally to the client, explaining the rationale and potential implications. 6. Respect the client's final decision, provided it is informed and does not involve illegal or unethical activities, while documenting the advice given. Question 20. Strategic planning requires a thorough understanding of regulatory frameworks. Imagine you are advising a client on a new investment product that offers a tiered commission structure. The structure appears to reward higher volumes of investment with a disproportionately higher percentage commission for the advisor. While the product itself is suitable for the client's risk profile, the commission structure raises a concern about potential bias towards recommending larger investments solely for the advisor's benefit, rather than the client's optimal allocation. You have reviewed the product documentation and the general commission guidelines, but the specific interpretation of whether this tiered structure constitutes an undue incentive or a conflict of interest is unclear. What is the most appropriate course of action? Option A. Immediately halt the recommendation process and inform the client that the product cannot be offered due to potential commission conflicts without further investigation. Option B. Seek formal clarification from KE Holdings Compliance Department or the relevant regulatory body regarding the interpretation of the tiered commission structure and its potential implications for client best interests before proceeding. Option C. Proceed with the recommendation, assuming the tiered commission is a standard incentive and the product's suitability is the primary consideration. Option D. Consult with senior colleagues informally to gauge their opinion on how such commission structures are typically handled in practice. The correct answer is C. Proceed with the recommendation, assuming the tiered commission is a standard incentive and the product's suitability is the primary consideration. Explanation. This scenario presents a professional challenge because it forces a decision between immediate personal gain and long-term ethical conduct, potentially impacting client trust and the firm's reputation. The core conflict lies in the temptation to exploit a perceived loophole for financial benefit versus adhering to principles of fairness and transparency. Careful judgment is required to navigate the gray area between aggressive business practice and unethical behavior. The correct approach represents best professional practice because it prioritizes client interests and upholds the integrity of the financial advisory profession. By seeking clarification and adhering to the spirit of the regulation, the professional demonstrates a commitment to ethical conduct and client welfare. This aligns with the fundamental principles of fiduciary duty and the regulatory expectation that professionals act in the best interests of their clients, avoiding any appearance of impropriety. Specifically, this approach would be supported by the KE Holdings Code of Conduct, which emphasizes honesty, integrity, and client centricity, and by any relevant regulatory guidelines that promote fair dealing and prevent conflicts of interest. An incorrect approach that involves proceeding with the transaction without seeking clarification fails to uphold the principle of acting in the client's best interest. It prioritizes potential personal gain over ensuring the client fully understands and benefits from the transaction as intended by the regulation. This could lead to a breach of fiduciary duty and potentially violate regulations designed to protect investors from misleading or unfair practices. Furthermore, it risks creating a conflict of interest if the firm or individual stands to gain disproportionately from a transaction that may not be optimal for the client. Another incorrect approach that involves consulting with colleagues for informal advice without formal clarification from the compliance department or regulatory body is also professionally unsound. While collegial discussion can be helpful, it does not substitute for official guidance. Relying on informal opinions can lead to misinterpretations of regulations and perpetuate potentially unethical practices. This approach bypasses established channels for ensuring regulatory compliance and ethical adherence, increasing the risk of unintentional violations. A professional decision-making process for similar situations should involve a structured approach. 1. Identify the ethical dilemma and potential conflicts of interest. 2. Understand the relevant regulations and internal policies thoroughly. 3. Seek clarification from appropriate internal compliance or legal departments, or directly from regulatory bodies if necessary. 4. Consider the impact of each potential decision on the client, the firm, and the profession's reputation. 5. Choose the course of action that best aligns with ethical principles, regulatory requirements, and client interests, even if it means foregoing immediate personal or firm benefit. 6. Document the decision-making process and the rationale behind the chosen course of action.